So as Terry said, we've worked together for a number of years. A little bit about my role. I'm Senior VP for distribution with Columbus Life on the East Coast. My time is spent these days back again out of where I cover hopefully getting out in the field and working with recruiting agencies, working with producers, presenting sales strategies, and out there doing business. Right. So I'm actually in my fourth decade in the business. It may not look like it, but I am. And most of that time I was sitting in the chair. I was a producer, worked my way up, was a manager, left the company, started a firm, did really well with it, and sold it a number of years ago. Sitting around going, what am I going to do now? And I got a call, said, hey, how would you like to come work in corporate distribution? I said, you're out of here. I'll never do that. That was 10 years ago. I'm still here. And what I found out about it was I actually liked how we do things at Columbus Life. It's very entrepreneurial. Like Terry said, you might think, oh, here's an insurance executive with a big fat salary. That's not how it works. I'm more like an agency manager, a little tiny salary. All my comp is variable based, commission override. So just like Terry said, if you guys don't sell anything, I'll get paid. I'm really, really incented to help you guys sell something. That's how it works. All right. So I love that model. That's why I took that job. If they had told me, no, we just pay a salary and you get a bonus, no chance. And so I probably would have started another agency. All right. So I like being out in the field. Because of being in the field, I've had the chance to work with thousands of producers, but a few hundred across the country who are super high-end producers. When I say everybody's got their different definition of what high-end may be, right? And that's fine. Whatever you consider high-end is great. I will tell you, I've worked with some guys who have, this is no joke, in the course of a year have done 90 million target. Think about that for a minute. You know how that guy started? He started back in an agency in a cubicle on Monday night making phone calls. Hey, can I come see you? Just like everybody else. He is no smarter than anybody else. What he did was he built up a heck of a network, exploited a niche, and he continues to do so. And he does it across the country. All right. So everything in between, every market you can think of, every ethnicity you can think of, I've seen it all. And so the good thing about that is I can bring some of that to bear when I talk with agencies, when I talk with producers, and we're going to get into some of that here today. So what I'm going to cover today is sort of what's going on in the industry, because that is extremely important. You need to understand what's happening. Terry touched on a little bit of it. Then I'm going to get into showing you guys what life insurance policies actually look like under the hood, right? Everybody gets hung up on an illustration. What's my cap rate? What's my max illustrated rate? Just throw that stuff in the trash. Why do two companies who have the same cap rate, one has dramatically higher income? You think it's magic? No, this is simple stuff when you actually understand how it works. I'm going to show you that. I'll talk about kind of what we do well at Columbus Life, where you need to think of us, because most companies will say, yeah, man, we can do everything. Well, no, they can't. Every company has niches. There are certain areas where we're better than others. I'm going to tell you where those are. I'm going to go through a fact finder with you guys, which may sound simple and basic, but it's not. Because when I mentioned some of those top producers earlier that I've worked with, where they excel is in asking questions. That's where they sell the business in meeting one. Not that you're taking apps, but they close the clients there because of the relationships they get with. And then lastly, we're going to finish with diving into this Capsure microsite that we've got built for you guys that was just updated yesterday. In fact, that's just a nice resource where you can go in and get, tools that are relative to what you're doing right away, not having to go through our agency portal and root around and stuff. So that'll be a lot better. So, and this is not a monologue. So if you have a comment or question, stop me. Because Terry said I had to fill 6 hours today. So we're going to try to. So, earlier the question about how old is everybody, how long you've been in the business. And I know a lot of us have been doing this a long time. And if you go back far enough, these are all companies we recognize, right? If you can see the screen. A lot of Kentucky Central, second on the list, Terry.
That's where I was going to brush my teeth.
So, and a lot of companies on here you've probably done business with. I'd have to go through here and make a checklist of how many I wrote business with. But some really good companies, right? Kentucky Central was a great one. Lincoln Benefit, long time ago. Philadelphia Life. Now, you going back. That was Connecticut General, another good one. First Colony, who didn't write a term policy with First Colony, right? Everybody did business with First Colony back in the day. Aviva, right? There was another one that was very popular for a long time. Sun Life, Life of Georgia. Man, I remember being a kid. I grew up in this little small town in South Carolina. Riding around, there was the Life of Georgia office right there on Main Street, and everybody, working selling insurance. Philadelphia Life, another one that was what's on it twice now. Who else we got on here? Of course, we got F&G. Who did they used to be? USF&G. You remember that back in the day? So again, money, executive life. Boy, that started. You're old enough to remember that started the downfall of insurance. That's the first one I really remember that actually failed. Right? What else do we have? Phoenix Life.
Oh, you got Bowie United. Bowie United did too. That
Yeah.
was the first one that
Yeah.
really messed everybody up. They had a 7% rate that they paid everybody.
Yeah.
And then they went out of business.
Yeah. How about JP? Everybody probably wrote JP. Hamilton, Paul Revere, another good one. Right? So we all remember these companies. Where are they now? Just take a look at this slide. Just think about this. We went from that to this in a period of 20 years, 25. So who you put your business with matters. And it matters more now than any other time. If we go back here, how many of you guys have done business with Ohio National? Okay, that's less than I would have expected. August. I call them September Moon, right? They've changed their name to August. So what happened to Ohio National? They were, for the last 20 years, I would have considered them the preeminent player in whole life distribution in the independent market. I think everybody would agree with that if you know that space, all right? And they had some really good whole life. They then branched out into getting really aggressive in the variable annuity space. Then they decided, against all reason, they were getting the disability market. And then they bought a company in Mexico or Bolivia or something. Anyway, started doing like this and they've gone on. But they started leaving breadcrumbs along the way. And you start to, if you're wise and you're paying attention, you start to pick up on breadcrumbs. One of the first breadcrumbs was in their variable annuity market, their variable annuity product. They had sold to everybody. So they come out and announce overnight that they were going to stop paying trail commissions to every registered rep that sold their VA. All right. So think about this. Think of everything you sold that you're getting trail income or renewals on. And a company just arbitrarily decides, we're not paying you anymore. I know the contract said we're going to pay you, but we're not. That's what Ohio National did. Well, needless to say, and they had sold a lot of VAs. The major broker dealers a few years ago all sued. Cambridge, LPL, they said, what do we can't do this to us. You can't do it to our reps. Big nasty suit. And so that was sort of the first clue that things are amiss. All right. And then, on my side of the fence, we have contacts at these different companies, and all of a sudden you hear, well, so-and-so's not over there anymore. And so-and-so's not over, I see he changed jobs. And it just starts disappearing. And then one day you hear about Bloody Friday, where 500 people get let go. And this is all exactly what happened over the last 18 months at Ohio National, to the point that they were a mutual company. They could not function anymore. So they sold themselves to a Canadian pension fund. And that pension fund renamed them Augustar. Okay, now let's think about this. If you buy a business, are you buying it to lose money? Of course not. You've got to have a return. Generally, on an acquisition like that, you're probably trying to make 15, 20%. It's kind of a going rate. So if currently I'm not owned by anybody, and my dividend rate or my crediting rate is 5% to all my customers that all your illustrations are based on, and now I sell myself, and I got to make sure the new boss gets his 20% cut, what happened to your dividend and your crediting rate? It's got to go down, and it's starting to now. I have agents that are moving their entire in-force block of business away from Ohio National. They don't care. Surrender charge doesn't matter. And they're not even having to sell it because the clients are getting so disappointed in what's happening. 1035 exchanges right now are taking 6 months. If you can get it, you can't get anybody on the phone. If you try to call them, I mean, just forget it. You're not getting anyone on the phone. So it's a mess. All right. It is an absolute mess. And I tell you that story because that is a microcosm of what happens when companies get in trouble. This isn't the first time this has happened, and obviously, here's where we are now, okay? So what causes all this kind of stuff? The interest rate market that we're in impacts insurance companies greatly. Everybody immediately says, wait, rates are going up. You guys must be doing great. No, actually it's getting worse. Well, that makes sense, Ward. How can that be? All right, I'm gonna tell you how. All insurance companies have portfolios where all of our money sits. Those general accounts, or those portfolios are mostly invested in bonds. Okay. 30 years ago, what could you get a treasury for? Be pushing double digits by then. Yeah, 10, maybe 12. All right. So today, if I have 100 million of 30-year treasuries earning 10%, and they mature today, well, I got to reinvest that 100 million of treasuries. What am I going to get today? Now you're back to 6 or 7%. So what happens to my portfolio? It's getting hit, right? So, I mean, companies, these have smart people managing their money. They understand this. So what do? So that ain't gonna work. We got to go find more return. Well, how do we get more return? We got to take more risk. What do? You get junk bonds. You buy companies in South America. You get really aggressive in product price. But what I mean by that is you go out and you try to buy market share and get as much premium in as you can and hope you can outrun it, right? Because particularly if you are, let's see, if you're Lincoln and you're publicly traded, or you're Allianz and you're publicly traded, or you're John Hancock and you're publicly traded, or you're F&G and you're publicly traded, what are you really worried about the next quarter, right? All I got to do is make the numbers next quarter look good. Because if I'm 55 and I'm only working 6 or 8 more years, and my bonus is contingent on performance, you think I'm worried about paying a claim in 30 years? I mean, this is human nature. This is how it works. All right. So you take more risk. You do things in product design that may not be the most ethical. You do things with product design that you hope maybe gets past the agent or past the client. And if you don't believe it, I'll show it to you, which is what we're going to do next. That. Yeah, I'll send it to you guys. Yeah. I'm actually, and that's not even exhaustive. I mean, there's more companies. We just brainstorming through those on there. I'm going to work on that slide actually. What I like to do is put all the company logos on there.
Is it the fact finder one or which one is it?
Wing. On the slide first, Allianz.
The point is trying to tell this to clients. They don't understand, right? I'm not there trying to explain the whole thing to them. I'm just trying to tell them, this is what's happening in the industry, right? Now it's a big,
Yeah.
I don't care how they got there or whatever.
Yeah, we'll get that out to you. So what we're going to look at here, something called a wing. Okay. Can you enlarge that, Terry? Let me get it up.
Yes, sir.
Just increase it so we're just have Allianz and Columbus side by side. We don't have to pick on national line. If I see that, okay? Marginally, okay, that's a good place to start right there. So this is a service we take advantage of. This is not Columbus Life material.
Is that better?
Yeah, that's fine right there. A company called Week, which is an independent group that takes company policies and puts them in a side-by-side format so that you can compare what's actually going on. There's no projections to, there's not an illustration, okay? Rather, this is what are the expense components of these contracts, right? So that you can start to understand what's happening from a COI perspective, a cost per thousand perspective, what's happening under the hood. That's what this is, all right? So what we're gonna look at here is Allianz versus Columbus Life. We can compare any company. So if you get in a competitive situation, you want one of these, give me a shout, I'll get you a report. As long as that company participates, which most do, most anybody you're probably going to compete against, I can get you a side by side. And usually within a day. If the company doesn't participate, and there are a few, what does that say? Right? Right up, red flag number one. You know? All right, so why Allianz? So if you look at current cap rates for IUL, the highest cap rate right now in the industry is F&G, which I think they're 12.75. Trust me, I could have put them up here too. Second is Allianz, they're 12.5 last I saw. And then third, unless something's changed in the last couple of days, was Columbus and about 3 other companies. We're all around, we're all at 10. Okay, so what you would see is sort of the bulk of mutual IUL strong balance sheet companies are all in a 9 to 10% range. Allianz and F&G are outliers, publicly traded companies. Okay, Lauren Bell too, right? You gotta start thinking about this. So a lot of times an agent will call me and say, Ward, I ran this illustration with you and Allianz, and they beat you, man. Their cap's killing you. Why in the world? What's wrong with you guys? Why aren't you competitive? What's going on? I said, how do you think they're getting that high of a cap rate? Because we all live in the same market environment, right? If you look up Allianz's annual portfolio yield, that is how much money do they make on their investments, it's about what we make. There's not a lot of difference. Most insurance companies make about the same rate of return because most insurance companies are invested the same way. We have a long time horizon, all right? Other than the ones that take a little bit more risk. So there's a reason that companies do that. How do I scroll down? You need to do it. Just scroll all the way down on this first page. Okay, what? Go back up. Okay, right there. All right. So I'm going to show you how you get a 2.5 point spread on a cap. So this is Allianz on the left. This is Columbus Life on the right. Okay, first a couple things jump out. Allianz surrender charge is 12 years. Columbus Life is 10. Doesn't sound like a lot. To an actuary, that's a big number. How would you otherwise state that? Their surrender charge is 20% longer. Okay, that when you're doing product design with actuaries, trust me, I sat in the room with them last week, and it's a give and take. Well, we can price it this way, okay, but I got to cover this on the backside. Surrender charge is one way they do it. Now, the client doesn't pay a surrender charge to it unless they surrender the contract. But the pricing assumption, when you're looking at an entire block of business over a long period of time, it shows up in assumptions. So actuaries love to go longer. So right off the bat, your client's now exposed to 20% longer surrender charge. If something happens, they got to get out. Okay. Wow. Didn't know that. What else? Policy fee. Columbus Life is at $4 a month. Allianz $7.50. That's almost twice as much. And you sit there and go, Ward, $7, man. What's the big deal? To that policyholder, it's not. But to that insurance company, that's a lot. How many policies are on the books? Thousands, tens of thousands. And on each one of those, I'm getting $7 a month. Do the math. That's a lot of money. Okay. So again, they're already twice as high. All right. So let's start thinking about this. Hold on. Already we're 20% higher surrender charge, twice as high on policy fee. Is there a theme developing here? Third thing, and this is where it gets really good, premium load. Hopefully you guys are aware, every time your client drops a premium in a policy, they pay a premium load right off the top with every company. Why? How do you think we pay you? That's where your commission comes from. That's where you guys get paid. That's where Terry gets paid. That's where I get paid. Premium load. That's the commission. So premium load matters. Where's our premium load? 6%. Where's Allianz? 8%. Okay, so they're 33% higher, but dig into the math a little bit here. Excess of target. So my guess is a lot of times if you write an IUL, and if you're doing it for accumulation purposes, you're probably overfunding a contract. Hopefully you are. If not, we need to talk. All right. That money above target is called excess premium. If you replace another contract and you 1035 the money over, that is always excess premium, right? It's extra money coming in. What you'll notice here is our load is exactly the same. Allianz charges 14% on excess premium. Let's put this another way. If you do a single premium case, which I'm going to talk about later, and your client drops in, now, let me take it back. I'm going to take an example from last week. One of my agents did a single premium IUL. The client dropped in $3 million. If he had done that with Allianz, he would have paid $520,000 in load. He paid $180 with us. Think about that for a minute. $520,000. Most agents are selling that product. They have no idea what's happening. Now, they're going to get an idea one day when that policyholder gets wise, or their son or nephew or neighbor gets in the insurance business and takes a look and figures something out. And that call doesn't come from the client, it comes from their attorney. I've seen it happen, all right? This is what's going on out there. So let's dig in a little bit more, because this is where things really, where you really have to understand what's going on. All right. So surrender charge is baked into the contract. I can't change that. The policy fee, Allianz is already at their maximum. Because see, there are two numbers here, guys. There's a current and a guaranteed. In other words, here's what I'm charging you now, and here's the maximum by contract I can charge you. These are levers insurance companies can pull if they get in trouble. So when an insurance company starts feeling pressure, I start pulling a lever. Now, what's really happening there? I'm taking return away from your client and giving it back to me. That's what we do. I mean, just gotta be honest with you. That's what insurance companies do, okay? But we all know that. So the real question is, what are you charging me now? And how much more can you charge me when things get tight? All right? So on the current premium loaded Allianz, they're at 8. They can go to 14. Imagine that. They're just putting 14% load across the board. Columbus, we're at 6. We can't go but to 7. We're not going to hit you. Yeah, we can't go that much higher. Same thing on excess target. Can you go to the next page, there? Let's get back there. Okay. So the real killer in a policy, by killer, I mean real expense, is the cost per thousand charge. And it's embedded in every contract, and it is based off of age, sex, and rating per $1,000 of coverage. Now, you'll never see this in a numerical format unless you ask somebody to send you the file, and that file is this thick, right? Because think about all those different parameters I just gave you. You can't really, can't disclose it in an easy to understand format. But that's what cost per thousand is. So you pay that as you go. So at Columbus Life, we currently charge a cost per thousand for 10 years with a maximum of 20. So if we got 11 years, 10 years down the road and the world fell apart and we're trying to keep the doors open, we can keep charging that for 10 more years. Allianz currently charges it for 15 years, 50% longer, but here's the killer, all years guaranteed. There are companies now, such as F&G, that charge this for the life of the policy. So you better have a 12.75% cap to illustrate anything that is a functional contract. So you get 15 years down the road and Allianz starts feeling pressure, they start jacking that lever. Now, does that matter? Okay, let's think about the 40-year-old you just met with, who you do an overfunded IUL LERP design. Guy's going to put away $35,000, $40,000 a year on top of his 401k to build a nice nest egg. And you're doing it based off an illustration that says he's only got to pay cost per thousand until he's 55. What happens when they flip the switch and they go all years and that guy's paying it at age 60, at age 7? How about when he gets to income? You think that matters? You think that's going to impact that contract? You better believe it. Something else that's not really on here is COIs. What are COIs? Cost of insurance. So in an IUL or any life insurance policy, there is a component of the premium that buys pure insurance, the risk portion, right? What does it cost us? What do you have to pay for us to insure you? Or another way of putting that is, how much of a bet are you going to make for us, the casino, to take your bet? That's what life insurance is if you hadn't figured that out. Your clients are gamblers and we're the casino. That's really what it is. They're placing bets with us. It's like on a blackjack table when you have odds. We got odds too. Our odds are made by our actuaries, and they're really good. That's all life insurance is. And I mean, you need to start thinking of it that way. So, cost of insurance. Okay. So, all right. So with COIs, if you actually map them out over time and you graph them, COIs are increasing over time in a UL. Why? Because they're current priced. So it's based off your current age and your current amount of pure insurance you're buying. So as you're aging, if you have a level amount of insurance, it should look just like this, right? Because you're buying the same amount and you're getting older. If you actually look at how IUL works, it actually kind of does this. It dips at points in time, because your net amount at risk decreases. In other words, your cash value is increasing and the amount of pure insurance goes down. That's a little bit inside baseball, but beside the point. Most companies, when they price COI, they're priced like this. They're going up as you age. If we actually took Allianz and we graphed their COIs, they would look, gotta show you this. They'd look like this. Why would they look like that? Why would somebody do that?
Well, down the road, they wanna make sure that they have lower costs so they illustrate better.
So if you actually do this, let's just say that's age 20. They're gonna look like everybody else's till you get to about age 60.
When I sold Kentucky Central, after the 10th year, we cut out all the mortality costs. Cause they said that you'd make it like the mortality costs,
And where are they on that list?
and they were,
And now they're gone.
but they vanished before the premiums did.
So you get here at say 60, and they dip all the way down to about age 85. They start going back up. Why? Like Terry said, we want the cost of insurance to go down because they built an illustration, not a life insurance product. And they want the income. Where do you illustrate income? When you run an illustration for a client, where do you start income usually? 60s. And you usually go 85, 90, 100, something like that. This boosts the illustration. So that on the back end here, when that client gets to their mid 80s and older, policy blows up. So one thing that we've been talking about a lot in Columbus Life and in some of our marketing is, what is your client buying? Are they buying an illustration or are they buying a product? Right? And there's two very different things. Because that illustration, as you guys know, once you have it, is basically worthless, right? It's just a projection that you're going to get a certain number every year linearly for the next. It's worthless. It's garbage. It's absolute garbage. But these things are not garbage. So one thing I want to encourage you to do when you start running ledgers, or if you find yourself in a competitive situation, tell the client, ask that other agent for their expense report. You should be getting an expense report on every ledger you run. And that is the best way to start comparing things, to see where those costs are. Because there's no free lunch. There's no free lunch, all right? If carrier A is showing X amount more cap rate or illustrated rate, why? There's a reason, all right? All you have to do is look under the hood and you're gonna see it. To be able to have that conversation with a client can really help. This is a little bit out of the screen here. You don't have to change that, Terry. But this was National Life on this side, which I didn't dig into them, but we could. But what you see here, that's a fund charge. So we don't charge one, nor does Allianz, to their credit. But look at this. National Life charges 2 basis points a month of your cash value for 30 years. Think about that for a minute. What happens if you get a zero? Right? What if your segment's 0? You still paying this? You bet you are. I didn't go away. They're hitting that every month. Most companies now charge fund fees. So again, when you're looking at an illustration, if you see somebody leveraging up a big bonus, for example, how are you paying for it? Probably in a fund charge. Yes, sir.
Is that on IUL and the whole life, National Life?
That's just on their IUL. They probably, I don't really ever look at their whole life contracts.
on there.
Okay, there you go. Probably something in there. The other thing National Life does that's really funky, and it's hard to get an explanation of exactly how it works, is what they require you to hold in the fixed account before you open a segment. You guys familiar with that? Okay, so, all right, so Columbus Life, our sweep date is the 15th of the month. We sweep once a month, all right? If you make a premium payment on the 14th, and we've got 100,000 net, right? Premium loads come out, upfront charges. You got 100,000 net sitting in your fixed account. The next day, we start your segment with $100,000. That makes sense, right? You paid for it. Here's your segment. That is not what National Life does. National Life, rather, their money goes into their fixed account, and they apply a formula to that deposit in the fixed account that determines how much money can go into the segment. So it's not the full 100,000. Now, what that number is, I can't tell you, because there's some moving parts there, but they do not do that. So think about that for a minute. You put the money in, you expect the whole amount, net amount, to be invested, and yet it's not. Now, why would they do that? right? This, again, it's got to be a little detective here. It's hitting real hard. So most companies right now, if you think about their fixed rates, where are most fixed rates? What have you guys? 4, 5? Yeah. So the reason for that is, again, most companies have similar investments and we're exposed to similar market conditions. Now, this gets a little in the weeds, but it's worth knowing. So when you pay a premium to Columbus Life, for every dollar you send us, we take 1 nickel and we hit IUL. How do I tell you, how can I guarantee you I'm gonna give you a 10% cap? How does that work? Right? Your 401k doesn't do that. But I'm telling you, I'll guarantee you 10%, pay you 10% if the market's high enough. How? We hedge it. We go to the options market and we buy options on the S&P 500, and I hedge the bottom and I hedge the top. How do I guarantee you don't go backwards in value? I buy options. I buy puts and calls, and I make a floor here of 0 and I make a cap of 10. So if the market's down 20, you're down 0. If the market's up 15, you get 10 on a cap annual point to point, right? So I do that with that nickel. Our approach is we are profit agnostic, profit neutral on whether you go into an index or a fixed account. So if you move that money into our fixed account, we're currently paying 4.2. So in other words, our option budget and our fixed account are pretty close. They run, within a percentage of each other all the time. We don't care where you put the money. If you want to buy our IUL and put it all in the fixed account, go for it. I don't know why you would do that, but we don't care. Doesn't matter. Doesn't matter to us. They're not accepted. So if you see a company, and I can tell you guys, they have the same option budget or they have less, which is a whole other scam that's being run. So if you see a company that's paying 3, you sit there and go, wait a minute. If the market's supporting 4 to 5% fixed interest, why are they paying 3? Where's the 2 points going? Right here. In a pocket. Now all of a sudden it starts to make sense why National Life does that, doesn't it? Because last I looked, their fixed account was around 3.5, 3.7, somewhere in that. Okay, now maybe I will force some money into the fixed account. Now, again, let's think about this: hundreds of thousands of policies, and you pay that premium, and I force you to keep it in the fixed account for a little longer. What am I getting? A positive arbitrage. I'm making money on your money. And what's happening to you? You're incurring a lost opportunity cost on that index. All right. So now when you start to think of it that way, then you look at another carrier. What else does National Life do? Do you scroll down one more page? Oh, and if you were to go up, you'd see their costs are between us and Allianz again. So same type of games. I think there's one more thing on there. Yeah, right there. Well, look at this way. I don't see that. The left. I don't see that. That'll go. Okay, those are the minimum guarantees. One more down, I'm sorry. It's not there. Okay. And then scroll over. That actually touches on what I just said. National Life and then dollar cost average feature and a fixed account, what they will allocate. What I was looking for on this one, it's not on there, but well, here it is. Again, here's where no agent, and this is all agents, by the way. It's not just us in this room. Nobody's going to take the time to read the fine print. This is what this does. It points out the fine print. This is, again, National Life. Minimum amount of funds must be kept in the basic interest strategy before excess premiums can be allocated to other strategies. There you go. They tell you. Let me tell you a little something else. Here's another game companies play. If you run an illustration with us, whatever state you choose, we input the state premium tax for that state, which is why if you run 4 different states with us, you'll see the numbers are different in each illustration because Texas has a different state premium tax than North Carolina, than Florida, than Georgia. So we allocate that in it. That's called full disclosure. Okay. You know what Allianz does? If you run whatever state you run an illustration with Allianz, it's exactly the same. Why? They use an average of 2%. Okay, well, if your state premium tax is 1, come out ahead. But the highest state premium tax out there is almost 5. Would you like to know that? Okay, but that's not the worst thing I've ever heard of. What would be the worst thing? Probably illustrating no premium tax at all. That's these guys. National Life does not illustrate state premium tax. F&G does not illustrate state premium. In fact, if you get a national life illustration, and maybe you got one, and if you don't believe me, pull out the illustration and look at the bottom of the illustration. On the page, there's a footnote. And that footnote says something to the effect of, this is only an illustration, there are no guarantees, and you may incur other costs not listed on this illustration. And that other cost is a state premium tax. Now, why does Allianz use 2? Because that's a nice round average. Do you think that 2% matters on that illustration? You better believe it. So what do you think national, think about that. You've taken 2% off, or another way to look at it is, what if I could put 2% more on mine? Mine would change huge, all right? But again, how do you know this? You gotta look, all right? So what have we figured out just kind of knowing we've got access to this report? The next time you're in competition with National Life, or you're thinking about, maybe I need to sell that. Well, okay, here's what your clients have to do. The money's not going in, and the illustration you give them is more worthless than usual because state premium tax is not disclosed. Maybe you want to think about what state they're in. What if they're in a 4% state? That matters, okay? What else here? You also on these reports, depending on the carrier, we can get into these carriers that are offering bonuses. We can really break down the bonus. Now, none of these 3 do this, but there are other companies that will have a bonus of like 1.5. And you go, man, that's great. That's great. It really reduces the illustration. Well, what's it cost? Right? We need to figure that out. So not uncommon to see a bonus of 1.5 and a cost on that bonus of 1%. Okay. He said, okay, well, I'm making 50%. Yeah. But what you start to find out when you read the fine print, that bonus is only applied to positive segments. Makes sense? How many positive segments do you have in a year and over time? On average, the market is up 6.5 out of 10 years. Or another way of saying it is a third of the time you have a bear market. So over a 30-year period of time, your client will get that bonus 20 years. But 100% of the time, they're going to pay the 1% fee. So do the math on that. Who's really making the money there? This isn't, I mean, guys, this is simple stuff. These actuaries aren't any smarter than we are. They just sit there with a calculator. Because I promise you this, every insurance company, from the top down, their actuaries are told, okay, you go design what you want, but you got to hit X profit margin on this product. You got to make 10%. You got to make 9%, whatever. Okay. Well, if I know that, then I can do all the little tricks of the trade here on product. Okay. What else do you find when you read the fine print here? This is one of my favorites. The bonus is only paid on the unloaned. All right. So why are you selling this IUL? Accumulation, income. That's what most of them are sold for. So you're designing a product to create income over a long period of time for a client, which means they're taking the money out. So the bonus that's being illustrated will not be paid on that money. Does that matter? Yeah. Do you want to know that stuff? Right. So we've got access to all that. So one more page down here. I think there may be one. Any questions so far? Oh, there's a question. All right. The loan rates are always good. This is just basically what I said. So here's National Life. And I'll read this so in case you can't see it. Current loan rate on this option is 5% arrears, market standard, and is guaranteed to never exceed 2% greater than fixed. But here's the next sentence that matters. Note, monies that are loaned against this option may receive different cap rates than monies that are not loaned. All right, so what does that mean? You sell a guy a policy. He's got $500,000 of cash in. He takes $250,000 out. The money that's in there gets the current cap rate of 10. The money he borrowed out, that might get 7. Wait a minute, I got to pay loan interest on that money I borrowed out, don't I? Yeah. You're going to reduce my loan? Nope. You're paying full interest on the loan, and we're reducing your cap rate. So when you actually have that contract in real life, think of the impact. But that doesn't show up on an illustration. Okay. So these are the games that are out there, guys. This is why it matters, because I can tell you this, because I deal with it. When these things go bad, and they do from time to time, it's ugly. And it is collateral fallout. And that shooting starts, they're shooting at everybody. And it goes something like this. Earl, we need you to come in here, we're gonna do a deposition. And I see here you sold this policy in, 2000. And I see here you were licensed for these 4 other carriers in 2000. And I see here that carrier X had a cap rate of this, carrier Y had a cap rate of this, and carrier X had a cap rate of this. But you sold this. Can you explain to me why you sold this one? You better have a good answer.
I got more commission.
Okay, it better not be that. You better be documented, right? And that's what I'm gonna talk about later is fact finding and file building. You better be able to sit there and go, yeah, here's exactly why I sold this. And a lot of times that might be enough. But when it's not, okay, it's paid up, they're writing a check. And I can promise you, the insurance company, if it rises up to the insurance company being involved, they're writing a check. They're not gonna stand behind you. Never, no chance, not happening. They're settled. Okay, so just know that. We probably fight a little bit, but most companies will not. Leave that right there. Here's some bonus calculations. Oh, yeah. Yeah. Okay. Here's my favorite. The Allianz Guaranteed Interest Multiplier. Okay. It's up here. I'll interpret. Their bonus options, there's several options. Their bonus says this: you will receive a bonus of 15% of the index amount credited for the segment, not to exceed 1%. All right, that is in addition to any other index credits you want. So I'll say it again. The bonus is 15% of the amount credited for that segment, not to exceed 1%. What is the bonus payout? How much your client gonna get? That's the standard guess. Does that everybody agree with that? Everybody agree 1%? Well, you don't know. Let's say it another way. What's 15% of 0? 1% is the maximum. 0 is the minimum. And what did we just say? A third of the time you pull a negative segment. So what's your bonus a third of the time? It's 0. What do you think is illustrated? 100% of the time you're illustrating a 1% bonus. 100%.
I just want to throw this out.
Yeah.
They are, I know it's a different thing for a different day, but they are very like this on their annuities.
Yeah.
Very,
Oh, yeah.
Very.
Yes,
old on the subject.
because they all lobby him out of it. That's the crookedest bunch of folks here, been around. Yeah, so AG 49 is the legislation, not legislation. Ron, problem number 1 is insurance companies are regulated by state. That's problem number 1. So you can't go before Congress. There's no federal agency like FINRA. The state's regulated. So every state insurance commission is almost called the NAIC, which is the National Association of Insurance Commissioners, who regulate stuff. So they try to come up with standards by which companies have to play by. Life insurance, property and casualty insurance, maritime, you name it, that's what they do. So as it relates to life insurance illustration, there's a guideline called AG 49, specifically relates to abuse and life insurance illustration. That was just revised last year. It's been revised like 3 times in the last 6 years because of all the IUL abuse. And every time it comes up, changes come up. It's like, it's like the zoning in your hometown. They do a public reading, right? And you got how many days for comment? And we know who the people are that are on these committees that make these rules, and they're getting bribed left and right. And I'm not joking when I say that. Now, they're getting a cash bribe? I don't know. But I can promise you the insurance carriers are all showing up and they got lives. Hey, let's just think gas. Nice bottle of Camus here. That is what is, it is just back and forth. And every company has a bias one way or another. So if you are a whole life only company and you don't sell IUL, you want to hammer it. Well, if all you sell is IUL, we don't want that. We sell both. We're kind of in the middle. We just want fair stuff, right? So
See, the money managers are getting beat so bad right now, they're fighting to make it even harder for us.
Yeah.
Because they're losing out. I was telling somebody in the car this morning that when you look at the billions of dollars that IUL and IUL annuities are taking, that's coming right off the top of money managers.
Sure it is.
Because almost every annuity that I have ever worked with, most of them had a manager that was managing it.
Yep.
And so they lost that trail on that business.
So the most recent violation, so to speak, or not violation, exploitation of the illustration guidelines has to do with the crediting and utility control funds. So I'm trying to make this as simple as possible. You guys know what a volatility control fund is? It's an option. They haven't been around mutual funds forever. And the idea behind it is this portfolio of investments will control or lower a client's exposure to volatility. Right, here's volatility. Going crazy, crazy, crazy. Up, I'm down, I'm up, I'm down, I can't sleep at night. The idea behind volatility is you get the right mix of investments, and instead of volatility like this, your volatility is like. So what you're doing is, in exchange for giving up the roller coaster ride and the ability to sleep at night, you're taking probably a little less return and less downside. That's volatility. That's basically it in a nutshell. So not too long ago, they found their way into IUL, into the index world. They're in annuities too. Okay. Why do I need volatility control in a guaranteed product? I already have a floor and I got an upside and I'm probably paying a fee in that volatility control. Why would I do that? You wouldn't. Why would an insurance company do that? Because it changes the illustration. So you remember I mentioned earlier, you have a nickel budget on every dollar to buy options. So what some companies found out, so that nickel, that option budget buys X amount of cap based off market conditions, based off a look back of how your company performed, determines your max illustrated rate. All right. So if you run an IUL, there's a maximum you can illustrate, right? And it's 6.2, whatever it is. There's a formula for that. It's very easy to calculate that. Well, the problem is, for a lot of companies, they didn't like what that spit out because it didn't look good. They weren't competitive. So what they figured out was, if I reduce my budget, so instead of a nickel, if I take 3 cents and buy an option and use the volatility control as a look back, this fund that, by the way, Goldman Sachs just created yesterday for me, that says it averaged 13%. That boosts my cap rate, or my max illustrated rate, and my cap rate, and the 2% that I did not spend on options, I can add on top. So let me put that another way. That is the equivalent of taking a $500,000 budget and buying a $500,000 house, or going out and buying a $500,000 house for 300 grand. Who's going to do what? Who's going to sell you the house for $200,000 less than they can get on the market? Nobody. But yet the insurance companies that use this system are able to inflate their returns and their max illustrated rate. Now, it gets in the weeds. I know it'll be hard to stand, but guys, that is just as brutal as it can be. So last month we were in Vancouver for a conference. A couple of folks in here were there. Bobby Samuelson was speaking, and Bobby is an industry expert. He's an IUL guru. He's a guru in all policies, but he's really good at IUL. And he did a presentation on all this stuff that I'm talking about, much better and deeper than I. And he was talking about all of the violations that are out there. And he made this comment from the stage to us and to everybody there. He said, I got to tell you, Columbus Life, you guys are doing it the hard way. What he meant was, you guys are doing it the honest way. You're not playing games like everybody else is. So does it matter? Yeah, it matters. Particularly when you get down the road, when it's time for these policies to perform, right? That's when it matters. When you go sell a client today and he's funding it for the next 15 years, it doesn't matter. It doesn't matter much. But when it comes time to pull it out, that's when it's going to matter. If you're still around, it's going to matter. And if you're retired, I hope your E&O has long tail coverage, right? Make sure it does. And one comment on E&O. So I mentioned F&G earlier. I'm not sure where their Comdex is, but it's not good. Does anybody know what a Comdex rating is? Okay, so all the Comdex does, if you don't know, there are rating agencies out there who, that's crooked game too, but they rate companies based off their financial strength. They use different language, each one, like A++, and the other carrier for the same relative strength may say A- or A, big A, little a2, very confusing. So what the Comdex does, it takes all that alphabetical jargon and puts it into an easy to understand numerical format from 0 to 100. There's no 0, but 100 being the best. So the higher you are, the better. We're 96. Okay, so 96, our peer group is New York Life, Guardian, Northwestern Mutual. We're at the top. We are the highest rated issuer of IUL, in fact, in the country. All right, nobody else can say that. So F&G 72. If you don't believe this stuff matters, I would challenge you to do this. When you get back to your office, pull out your E&O and read your policy. And if you have your policy, you might only have the deck page. But if not, call your carrier and say, you send me my policy. Sure, they'll email it right over to you. And what you will likely find in there is language relating to when they will pay a claim. And it is not uncommon to see language that says, if you sell an insurance company with a rating below X or a Comdex below Y, there are plenty of people out there selling F&G who are fully exposed. They have no idea. Most agents have no idea, because they don't tell you that when you call them and get your E&O.
What's the percentage of an agent getting called on the carpet when they're comparing with somebody? Say, why did you sell this policy? You know what that might be?
I don't know what the number is today. I will tell you that number is growing. With the growth of IUL sales the last 10 years, because think about this, IUL has taken off really 10 years ago is when it rocket shipped up. In fact, I got recent LIMRA numbers. It's just, still not slowing down. And so originally, when the IULs first came out and the bonuses started being added to contracts, I think the first one was Minnesota Life and like North American. And they had a rule, their deal was you get a 75 basis point kicker after year 10, and it's non-guaranteed. But guess what? They illustrated it. So your illustration looked great, but they're not obligated to pay it. So we're at about year 11-ish, 12. So there's a lot of question here about, are these bonuses going to continue to be paid? All right. So Minnesota Life. What happened to Minnesota Life? Anybody know? I let them off. Well, first of all, they're not Minnesota Life. They changed their name to Securian a number of years ago. That was their marketing name. And in November, I was in Cincinnati at a home office meeting, and on consecutive days, I got 2 emails, announcements, I should say. The first one was Minnesota Life / Securian announces they're ditching their field force. They used to have a career field force, and they had an independent distribution model. We're done. They sold it to Cetera Advisors. Okay, that sounds kind of like the Ohio National stuff, doesn't it? So I got rid of why would I sell my team? Why would I sell the people who sell my product? They unloaded it. All right. So that's a company who is supposedly going to pay this non-guaranteed bonus. How do you feel about that non-guaranteed bonus going forward? All right. So to your point, somebody bought that contract and put a lot of money into it 10, 12 years ago, and they're starting to get to the end of the finish line. They're sitting there going, hey, honey, we got that $280,000 a year we're going to get out of that policy. And all of a sudden, they're going to run an in-force, and it's going to say, you're not getting 280, you're getting 131. What? That's $150,000 a year over the next 20 years. That's $3 million I'm not going to get. So there's your question. So some agent is going to get called in. They're going to say, pull out that Minnesota Life illustration. So that was day one. The next day I get another alert. Mass Mutual, this was, I guess, last November, announced immediately, even for policies in underwriting, that they would no longer support bank on yourself, infinite banker strategies like that. All right. Normally, when companies say we're not doing that anymore, and that's not uncommon, companies make decisions. But normally, if we come out and say we're not going to do that kind of business, we're going to give you a runway. We're going to say effective, January 1st, we're no longer taking this, and all business in-house, we're going to process out. They cut it off right there. So for the agents that had submitted all that business, you were done. So you presented it to your client. They said, yeah, I want to do that. All right, we're waiting on the policy to come back, and now you got to call them and say, we're not going to do this. How does that agent look now? Right? That agent was stupid. They were crooked. Right? So these are the kind of things that go on. So that's another way an agent ends up in something like that. So they have to struggle to go where.
How long are some of these large companies like Northwestern and Columbus Life and Mass, if you've got large policies, they're going to require you to keep your,
As an agent?
Yeah.
we don't have any requirement on the agent except at time of issue. You just have to be covered and you write the contract. Now, and if you're active with us. Okay, so as long as you're active with us, you've got to have coverage.
So if you turn your license in, some people say 5 years.
I think you should. I would, but once you if you terminate with us, with, Northwestern, probably the same thing. Now, with us, you go get your own email, right? We don't have a program.
Get some tail coverage.
Get tail coverage. If you're with a career carrier like that, they're telling you most likely what E&O you're gonna buy. And you have to go through the group plan. And if you don't, they won't, you're not covered. But why do you think they're telling you to go through that group plan? Because it covers them. They got tail coverage, all right. They got Northwestern tail coverage.
Are we still under the gun if we turn our license in and?
100%. You're always under, you sold it, you're responsible till the end. It doesn't expire. It doesn't expire. So, I mean, that's a great point to think about. What about something you sold 30 years ago? Now, to you, that's a long time ago.
Hey, I cringe about that
Yeah.
because when you have a hierarchy, it goes all the way up the hierarchy.
Yes, it does.
Because, we laugh about it, but it ain't funny. When we sold those Kentucky Central policies, in 1983, I sold Kentucky Central, and the illustrated rate was 11.75. And after 3 years, it bumped another half a point.
Mhm.
So I was showing 12.25% interest rate. Okay, so then back in 1993, they had 33% of their assets under one conglomerate, which was these brothers that owned a lot of real estate in Kentucky. And so the insurance department came in and told them that they were going to shut them down. So Kentucky Central sold all the policies to Jefferson Pilot, every one of them.
Yep.
Well, then the company says, and I was making good money at that time. You know what I'm saying? I was making, almost 6 figures a month. My income went down to $7,000 a month in 90 days.
Sure did.
Well, the worst part about it was that the Jefferson Pilot, I couldn't service that business because I happened to be in Raleigh, and they had like 30-something managers that worked for Jefferson Pilot. So they gave everybody else a contract all over the United States but me. I was the only one that would give a contract to because they said, well, we don't want to compete with Terry. So then they bought the policies, and Aaron will tell you, we get a phone call, what, Aaron, every day? At least every day, from somebody saying, hey, I'm ready to retire on my policy. This illustration shows I'm gonna get like $5,000 a year. And I say, have you been looking at your annual statements? And they'll say, no, I'll go run annual statement. And the worst one was a guy that was 89 years old, and his kids came over to the office, and he was from New Bern, North Carolina. And his policy that the agent sold him, and he hadn't seen this agent forever, it showed him, he was gonna be paid up and he had to pay more premiums. Well, he got a lapse letter. And so I had to run the illustration, and he came over there. Now, look, I ain't getting any money. I'm just servicing it to help the guy. It was $26,000 a year to pay his premium, to keep his $300,000 at 89. And his kids said, well, I can't afford that. And I said, well, the thing is, I don't like to play mortician, and I don't like to play God either. Do you 3 boys want to pay the $26,000 to get $300,000 death benefit? And they go, no, I don't want to pay that. Well, then when you go look at the illustration, I never paid much attention to it where it said the current rate and the guaranteed rate. Well, so the thing that's a saving grace for all these policies is that it has to be guaranteed. If the company goes in, they got to do that whole block. So if I change the current rate to the guaranteed rate, it has to be for that whole block of business. So when Jefferson Pilot did it, they have gone down to the 3% rate. Okay, I sold a bunch of that Minnesota Life. I quit selling Minnesota Life about 5 or 6 years ago because they would let you sell the policy for $1 million, cut it back in 5 years to $500,000 and not do any chargeback, and tell the client he can still put his money in it, it wouldn't cause it a meg.
Yeah.
I said, man, I'm running from this. Well, then I wrote with the agents, we wrote over 20,000 policies with ING. And I'm just telling you this because just so y'all all know it. G sold that block of business to Resolution Life. Well, I was getting my renewal commission, which was a pretty good check. Well, then I called them up in January this year and I said, hey, look, I didn't get my check this month. They said, well, we're not paying it anymore. And I said, well, you gotta pay it. And they said, well, we don't. I said, well, I have a contract. They said, with who? I said, with ING. They said, well, we're Resolution Life. We bought the policy. We didn't buy your contract. We bought the policy. We have no agents. I said, well, I'll sue you then. And they said, well, get all your buddies to sue it at one time and so we can just fight y'all all at one time. And I said, okay. And so then it started going downhill worse. And I said, well, look, whatever my renewals are, I'm gonna replace enough business to do that. They said, we wish you would, because every time you replace a policy, it frees up our reserve.
Yeah.
And we make money.
That's right.
And so, I started my business in 1979, and here it is, 2020. And that 42-year period, interest rates have never went up on the policies that I sold, ever. They've never gone up, and so when we look at all these policies, Aaron will tell you, we've hired people to try to work those leads, and I get probably what, Aaron, 25 a day, 25, 30 a day, the annual statements. And, it makes you want to cry, because you go in there and look at this thing and you'll see the people's cash is eating it up. So these carriers, not only do they do that, well, see, then now they don't tell you didn't pay your premium. I had a client that skipped 2 payments of over $100,000. And his policy was supposed to be paid up at age 90. Well, because his trustee did not pay those 2 premiums, and that was 13 years ago, now he's got to start back paying premiums, and he's got to pay $173,000. How would you like to go tell a client that he's got to pay $100,000 till he dies so he can have his insurance in force?
Yeah.
See, those are the things that, with the graying market and all the things that we've seen happen, and see, thank God that we don't have STOLI anymore, stranger-owned life insurance, because so many guys sold all these policies. Well, then that market went out and bought those policies. So those policies are going to be a death claim sometime
100%.
for some of these carriers.
Yeah, the STOLI business doesn't come off the books.
They knew it when they bought it.
Right, it's staying on the books. So I'll finish with this story and we'll come back to some 45s. Okay. Here's what's gonna happen. Here's how people get in trouble. Know an agent who sold an Allianz policy, legit sale, to a senior who bought this big premium sale for death benefit for her kids. All legit stuff. The commission was just under $1 million. All right. That was for the agent, the agency, all the way from everybody involved. So about 6 years in, her know-it-all son gets involved, all right, who starts picking up a storm and saying, this is bad. We they range a guy or whatever. We don't want this. You screwed my mom here. This is bad. And, file a complaint and all that sort of stuff. So Allianz takes a look at it. And instead of standing behind the agent saying, no, this is legit, or if you want to surrender the policy, surrender it. We'll give you your money back and interest for any charge. Allianz rescinded the policy. In other words, they said, okay, we'll just treat this like it never happened, Miss Client, and we'll give you all your money back.
You charged the agent back $1 million.
$1 million charge back up the line. The agent got hit with like a $700,000 charge back. 6 years later, he had filed bankruptcy. So that's the kind of stuff that's out there. Hey, there you go. That's what happens. So, all right, why don't we take a break and re-adjourn at 10:45? How about that?
Hey, Will,
I should have scared them.
Will,
You think so?
I mean,
Will,
Yep.
can you pause the recording? And can you hear Ward real good on the recording part? Is that-
Yes, I can. Yep.
Great job. Okay, just pause it and I'll call you back.
we want this info.
Look.
We're all getting out good.
I scared you enough now. We're all out there. You can sell cars. So what I want to talk about now is a little bit about Columbus Life specifically. So you can kind of know where we're best, right? Because hopefully, over the years, as you've dealt with other people like me, when you're talking to a company distribution person, they should be able to tell you, here's where we're good, here's where you want to use us, and here's where we're not so great. And if they're not willing to tell you both, you don't want to deal with them, because no company does it all. Every company has markets they like better than others. Yeah, maybe they'll sell you a policy in a different market, but you're not gonna have maybe the same underwriting experience. They pay differently, who knows, right? But those are things that are important. And so that's what I wanna focus on right now, so you know kind of where we're good, the kind of business we want. And this isn't just me saying this is really an alignment in our corporate strategy, not just on distribution, but underwriting and product design in our advanced markets team. So, you know, when you're working with an insurance company, there's always the person like me in some role who's gonna tell you how great things are. We're gonna do all kind of business together, right? That's my job. But, you know, over here, I got underwriters whose job is to say no, let's be honest. We got the actuaries whose job is to make sure they make more money than you. And so everybody's gotta be on the same page, all right? And so these are areas, and again, I was just up there last week with our leadership team where everybody is aligned. And what you will continue to see more of from us is future product development, advanced market resources, underwriting resources, all